Okay, peeps, welcome back. So today we're going to be going over the macro markets overview for September of 2024. So with that being said, let's get it. Okay, so we're going to go over some outliers first, and then we'll go over the charts. So first thing here is the fear and greed index. You guys can see that we're at a neutral right now. So I think the reason why that is because the Fed is waiting, or not the Fed, the markets are waiting for the Fed rate cut this month, which I'm pretty confident at this point it's going to happen. So you can see it's kind of a mix of things. Again, I think it's just a matter of the markets waiting for the Fed to cut rates. So we have the Fed watch tool here. This is what the market's overall expectations are of the Fed and what they're going to do in the upcoming FOMC meetings. So you can see the generalized basis here. The general consensus of the markets is that we're going to get the quarter basis point cut. I think that personally, at least from the onset, would be the best possible outcome for all parties involved. That includes for the Fed, for inflation, for unemployment, for investors, for the markets, for the economy. Just kind of a best case scenario would be to start, maybe, in my opinion, the Fed could test the waters with a quarter basis point cut and then decide how to proceed from there. Plus, if the market sees something crazy like the Fed cuts by 50 or 75 or 100 percentage points on the first meeting, they might freak out and be like, oh God, the Fed's going to lose control of the economy. And, nobody wants to see that. So, in my opinion, I think there's a strong likelihood, much stronger than 56%, that we see just the 25 basis points. So in November, you guys can see it then pops up to, it looks like, more of a likelihood of a 50 basis point cut. Again, I think the Fed's going to dip their toes in the water initially when they cut to see how everything kind of plays out. They'll probably be data dependent as they continue to cut to ensure like a soft landing scenario is what I think is likely to happen. So December, you guys can see now we're down to roughly about 100 to 125 percentage points. Again, that would not shock me. Personally, I think it's probably going to be something like maybe a 20 or a 25, a 25 and a 50, or a 25, 50 and a 25, or maybe a 25, 50 and a pause and then like a 25 or something like that. Not exactly sure what they're going to do this time, but I have a feeling that they're going to do something different than what they normally do. So that's the FOMC expectations. Again, this is on the 18th. Yeah, it's on the 18th of September. So if we look at the calendar here, you guys can actually see that is 2 Wednesdays from now. So there's going to be some more data that the Fed's going to get before they do their FOMC meeting thing. But as you guys can see here, one of the major ones is going to be, of course, CPI. So that comes out the 11th. That is a week from today. So they're going to get this a week before they make their decision. Now, this is the thing I actually wanted to talk to you guys about. This is the global liquidity index. Okay. So it's basically pretty much exactly what it sounds like. The thing I want you guys to notice here is usually these things move in waves. Okay, they move in cycles. I could go over this in depth in a separate video, but kind of the generalized thesis of what I'm thinking here is that if the global liquidity has hit a peak and it's going down, that usually indicates to me monetary tightening, whereas if it hits a bottom and it's going up, that indicates monetary loosening. Okay, monetary loosening in this case is good for economic expansion, business expansion. Markets generally, I would think, would go up, and we'll see like cheaper borrowing rates and stuff like that. So you can see that this thing is slated, and we can talk about this more in depth in a separate video, but you guys can see this thing is slated to go up through 2023. It looks like until probably about 2026. Again, I'm actually going to show you guys one of the reasons why I think we're likely not going to go into a bear market or into a recession next year. And again, a lot of people think that this stuff doesn't line up, but in my opinion, it has to line up because, again, it just makes perfect sense for it to do so. So this video is not really about Bitcoin, but I kind of want to show you guys this so you can see how the global liquidity index lines up. So you can see on Bitcoin in 2014, 2018, and 2022, we had our bear markets. Okay. So usually 3 years of green, 1 year of red. That's usually what happens here. So if the cycle is to repeat, then theoretically the rest of this year and all of next year should be green for crypto. And then we have our bear market year in 2026, because again, it's four years forward looking out. So if I go back here to the global liquidity index, you guys can see that the peak, see this little line right here, lines up almost perfectly with the peak of the global liquidity index, which is then when the monetary, or when the flow of money, I should say, in this case, it starts trending to the downside, which is in theory when there's possible recession in 2026. Again, I still don't think that's a strong likelihood, but because again, the conditions of what we're dealing with in the economy right now are extremely unique. Okay, it's not something that the country has ever really experienced before, so that's the reason why I'm kind of treading lightly here when I say this. But regardless, I'm expecting crypto to have a bear market year in 2026, and you can see that the global liquidity index lines up perfectly with that. Okay, so now that we've talked about that, and I do generally believe that stocks also will go up as well during 2025. I don't think we're going to see some kind of major dump. Again, it would just look bad for all politicians involved if something like that happens. They love to brag about when the markets are going up to all-time highs because it makes them look good. I mean, why wouldn't they, right? So obviously they don't want it to go down. Plus, there's a financial incentive for members of Congress and the President of the United States to actually see these markets go up because, again, Congress does write the laws that either work to the benefit or detriment of some of these companies, which you guys know are already factored into the pricing of the SPX. So in terms of the SPX here, we're in bear seasonality. Okay, usually in September we do get some kind of pullback. Whether it plays out through the rest of September or not remains to be seen, but you guys can see the last couple of years this has happened. So September is usually the worst month for risk on assets. But one important thing I wanted to show you guys here, another reason why I think likely a bear market's not coming next year is because, so we got one back here in 2020. This was the flash crash. Of course, we kind of sort of had one back here in 2018. And again, once again, that does line up perfectly with that global liquidity index, minus 21%. Yeah, you guys can see this little dash here lines up right about this peak here in 2018 before we saw the Fed, tank the markets by 21%. Then 2020, same thing, okay? 2020, where's the peak at? 2020, boom, we went down into a bear market. But the other thing I want to point out here is when we snap past these all-time highs, okay? Usually when we have some kind of major sell-off and then we go past the all-time highs, we usually don't stop going up for quite some time, okay? It usually takes quite a while before we see some kind of sell-off. So in this case, we had 190 days, 17%. When we snapped down during the pandemic and went back to all-time highs, we broke out right here and past the all-time highs until the eventual top. This was 427 days, 35%. And then we snapped these all-time highs right here, as you guys can see, right about here. And as of right now, we're currently only a very small amount in, 231 days. In my opinion, if we did not have the pandemic flash crash right here, I think likely we probably would have measured it like somewhere around this is what it would have looked like. So it would have actually been closer to about 900 days. So the timing of this thing is not perfect exactly, but again, I don't think it's likely we're going to see a bear market next year. And usually, the recession indicator will start flashing when the yield curve uninverts. Okay, so usually the economy and the markets are on a timer at that point. Usually, when the yield curve fully uninverts, it's usually about 12 to 18 months out. So again, that would line up with 2026, but I'm not saying that's going to happen. It's just the timing of it all. I'm trying to throw it out there for you guys. So SPX, I do expect a rally throughout the end of the year. I do think that's likely going to happen because again, we got elections and all this other stuff going on. Okay, NASDAQ slight pullback. It's possible maybe it bottoms out here at 17.7. We could see maybe a bottoming out here real soon, right around this 18,500. You can see kind of this flat top area could be treated as support here. Very kind of similar with the SPX. It's hard to say exactly where this one would bottom out. I would say maybe somewhere around the yellow EMA, so maybe 5,400. Again, we have had quite a few bounces throughout history along these EMAs, but it's really difficult to say. I mean, I don't know exactly where this thing is going to bottom out. SPX is kind of a hard one to read. So Russell 2000, this thing may have already hit its bottom. It's hard to say. But this white line, which was resistance, could turn support. So that's roughly about 2130. Of course, we're looking for the all-time highs here, 2360 to roughly about 2450. I am in the same camp as Tom Lee. I do think that these small caps are going to absolutely rip. I'm talking like moonshots. Don't take my word for it. Do your own research, Kay. But in my opinion, I think small caps are going to rip when the Fed begins the rate cuts, okay? As a matter of fact, I do think the markets are going to have massive rallies on the day of and the day after the Fed rate cuts, and it could even continue for like the explosive part of it could continue for a while, for a couple weeks, maybe a couple of months, and then the markets just kind of ease into going up, okay, or something along those lines. But yeah, if that were to happen and the Fed cuts and then Russell rips to the moon, I mean, just to get back to all-time highs is roughly about 15%. Dow Jones, so we still got the all-time high previous support here. Personally, I don't think it goes that low. I would say maybe if it were to bottom out somewhere around 40,000, because we kind of have like a double top there, which again, you guys could, if you understand TA, you know that this could be a flip zone right here. So maybe another 2% down is nothing extreme if you ask me. Okay, so stocks above the 50 and 200. We'll start with the 50 first. So we're kind of sitting in no man's land. Again, generally speaking, when we get down in the green box, that is the most ideal time to buy. Red box, most ideal time to sell. When this thing is above 50 or pretty close to 50, that's usually risk on for swing trades. So a lot of swing traders, when they're looking at this, they'll say, okay, it's above 50. I think we're going to go for some swing trades, and then they take on their swing trades and whatever kind of stock they're looking at. Of course, it doesn't just include this. It also boils down to the technicals of the underlying stocks. So you can see the rare occurrences that these things actually enter these zones. But we cover this once a month. So if it does happen, we'll update you on X that something like that has occurred. So SPX, you can see this one's even more rare. So 1, 2, 3, 4 times since 2020 in the buy zone. 1, 2, 3, 4, 5, 6 times in the sell zone since 2020. So pretty rare. Only 6 times in 4 years. But you can see the SPX one is actually getting quite a bit higher, closer to that sell zone. It's not so in the middle like the NASDAQ, as you guys can see. So based on that, I would say the NASDAQ is actually a little bit more undervalued compared to the S&P 500. So NASDAQ above the 200-day, we have roughly about 60%. Again, that is swing trade and long-term investing on. Usually when this thing gets below 50, that's when investors start to be a little cautious. No guarantee that it goes down, but you guys can see if I draw like a white line here, right about this, see if I can find it, right about this 50 level. You guys can see usually when it does get below the 50 level, it usually has some pretty serious sell-off here, and then we get into this major buy zone. It's only happened 4 times in the last 4 years, or last 6 years. And then the sell zone, we've only hit that 6 times. So I don't think this one's really that expensive. I think if we were up here, I'd be like, okay, yikes, maybe we might have a major pullback, but I'm not really seeing any red flags. SPX, 200-day, so this one's even more rare. We only had 4 buy signals here on the green zone. 1, 2, 3, maybe like 3.5 right here, sell zone signals. It's kind of at the top of this area, but again, if we go back in history, usually when the thing's in a bull market, when the S&P is in a bull market, you guys can see this thing does spend a lot of time by that sell zone, and it can be in that sell zone for a very long time and not sell off, okay? So when it spends a lot of time up there, it doesn't necessarily mean it has to sell off. That's actually usually what happens in a bull run. Okay, so uninversion of the yield curve, we'll talk more about this in a later video. This is going to be a separate topic, but the 210-year spread is only 1 percentage point spread at this point. So it looks like it's getting ready to uninvert. We'll talk about what usually happens in a separate video when this does have a full-blown uninversion, which usually doesn't happen until the Fed cuts rates. I'll just reiterate back to what I said before. Okay, I think likely because we had two technical bear markets and two recessions, as it were, in 2020, 2022. I know 2022 wasn't classified as a recession, but in my mind, it was a recession. Okay. The markets were dumping off a cliff. The Fed was tightening rates. And if the markets are falling when the Fed tightens rates, that's usually a really bad sign because usually when the Fed tightens rates, the markets go up. They don't go down. But in this case, they went down. Okay, so we had two bear markets in the last 4 years, which leads me to believe likely when the Fed cuts rates, the markets are going to go up, not down. Okay, it doesn't mean we can't have pullbacks along the way. We always could. But I still think the 2025 crypto bull run is on. I still think that stocks are going to go higher next year and this year as well. I think the Fed cutting rates is going to lead to a soft landing and going to lead to the economy expanding and to the markets going higher, which again is contrary to history, but markets don't usually go down when the Fed hikes rates. They usually go down when the Fed cuts rates. So again, I'm expecting the opposite effect here. Okay, so Fed funds rate, we already talked about that, so we don't need to go over that anymore. We'll get the inflation reading later this month. You guys can see that inflation's looking good as of right now. So unemployment rate, I have been keeping a relatively close eye on the job market. I could be wrong about this. Usually when unemployment starts to go up, it usually goes up more aggressively, faster. I personally think that when we get the unemployment rate this month, I think it's actually going to tick down because I have seen a lot more job openings open. So my guess is they're hiring for seasonality. Again, Christmas, Thanksgiving, stuff like that. And I think, like I said before, I think that companies are going to hire more people in tandem with the flow of the rate cuts from the Fed. Okay. So I think there's going to be an easing back into economic growth. I think it's going to be much different. The turnout of events is going to be much different than what people are expecting. So now let's go ahead and talk about oil. So oil is a very interesting one. I got to find it here. So give me a sec. All right. So we got oil, crude oil. All right. So there is one major thing I wanted to point out about oil here. Okay. Usually when the Fed is not tightening rates, okay, when they're going into monetary easing, or when they are in monetary easing, you guys can see the price of oil, generally speaking, is usually at lows. Okay, it doesn't really do much when the Fed has the rate sitting at lows. You can see here between 2016 to 2018, it kind of didn't really do much. I mean, it moved in between like $26 a barrel and $75 a barrel, which is a wide spread, but we didn't see anything like what we're seeing now, like this. Okay, where it goes from almost $0 a barrel all the way up to over 100. What is this, 130? So the point I want to make here is I expect when the Fed cuts rates and the economy goes back to normal, okay, and there's no recession and all that stuff, I expect that oil is going to normalize. It's kind of just going to bob around. Okay, it might go up in between zones here or there, but it's not going to do any extreme moves like a 13x like it did here. So as of right now, the W pattern is still possible, although I think it's not likely. Again, when Trump gets reelected, I think all the conflicts overseas are going to come to a screeching halt, which means that the price of oil will likely come down and stabilize. So in terms of technicals, 61 to 76 is support, and 91 to 95 would be that resistance zone or target zone. Again, when the price of oil, the underlying commodity, comes down, that's usually when I become a little bit more bullish on oil-related stocks like Chevron and ExxonMobil and stuff like that, because generally speaking, they're much cheaper to buy. That's been my experience anyways. So let's go over the metals now. I'm going to run through these real quick, go over to the monthly time frame. So, what do I think is going to happen with metals when the Fed cuts rates? Well, I think what's going to happen, assuming that there is no recession, okay, there's a soft landing, there's no recession, all that jazz. I think likely the price of metals is going to come down. Okay, that's what I think. In this particular situation, you guys can see we kind of had the recessionary period right here, and then gold took off like a rocket ship. Assuming that there is no recession or there's a soft landing, a transitionary phase for the economy, um, I suspect gold is going to do something probably more like this in a non-recession scenario. This would be something that we would see in a recessionary scenario. Okay. So I'm actually expecting the price of gold to come down in price. That's what I'm expecting. So if Fed cuts rates and the price of metals comes down, how much they come down, I don't know. I will tell you guys, usually when I look to buy metals, I do not buy them or try my best to avoid to buy them unless I see them hit a major support. This is on the monthly time frame. So this, in this case, would be from 1800 to about 2080. If this thing does drop, it could drop roughly about 30%, as you guys can see here. Of course, when everybody's gobbling up all the metals because they're afraid of like, oh God, there's going to be an economic collapse, go buy all the gold and silver you can, right? Then it becomes harder to get a hold of it because the mints can only make so much of it, which means the coin shops are going to charge you more money in premiums. So not only is it per ounce at all-time highs, but you also have to pay an arm and a leg just to be able to buy it from the dealer as well. So there is that also. So silver, this little thing right here, whatever this looks like a potential reversal. Again, we do have a possible triple top here. So silver might come back down to maybe this trend line right here or to this green line. So roughly about $20 to 25. If I give you guys the measured moves here, it's roughly about a 14% drop to about a 29% drop. I might be willing to buy silver at like around 20. I personally would probably not want to buy it any more expensive than that. So 850 to 14 as support, and then you have roughly about 30 to let's see here, about 35, 36, somewhere in there. Just to show you the worst case possible scenario, if it goes back down to those previous candle lows, about a 51% drop. I don't think it goes that far, but anything's possible. So white line all the way up to resistance, 42%. And then the green line all the way up to resistance, roughly about 75%. Palladium. This one I would be much more interested in buying. You guys can see it as a literally sitting exactly on a previous flip zone here, so roughly about $900. And then the all-time high up there is at $2,900. As you guys can see, the pandemic kind of really caused this thing to moonshot. So possible upside here. Again, this could take years to play out. It doesn't necessarily have to play out fast. If you guys are looking for fast, crypto would be much better than this. Not financial advice. So 283% move. Platinum, same thing, is sitting pretty much all the way at the lows. I'd even be willing to buy it right here. So support is 780 to about 820. Resistance 1760 to roughly about $1,900. So just to get up to this resistance, roughly about 113% move. Copper, this thing has not fallen off a cliff, which tells me that demand is still strong within the economy because you guys, as you guys know, that those of you guys that know what you know about copper, it's an industrial metal, so it's used for a lot of really practical things. So the fact that this is still sitting at highs tells me that the economy is strong. So $140 to $2 at support, 410 to roughly about 510 up there at resistance. If there is a pullback, I mean, the pullback could be, of course, pretty large. So sitting at roughly about 67% there. Okay, so we're not going to talk about Bitcoin in this video. We'll do that separately. We're going to go over the DXY and the VIX. Okay, so DXY, when the Fed cuts rates, at some point I'm expecting the dollar to fall off a cliff. It doesn't mean the dollar is losing value. It just means that it's not desirable anymore. People that are not getting as much money on their cash and cash equivalents are going to want to move money into things like crypto and stocks, out of metals and cash equivalents into crypto and stocks. And that's usually what happens when we see the dollar fall. So broke this trend line, it's looking like it's going to break this EMA, which is indicative of the high probability of a Fed rate cut this month. And then it's got to break this support to get that sell off for Bitcoin to kick off to all-time highs is kind of what I'm thinking. So it's looking good in terms of the transition from risk off to risk on for investors. VIX had a little tiny spike here. This could be the start of something bigger, but I would argue probably likely not. And the reason I say that is because if we attach the wick highs here, you can see it hasn't broken it. And we had this crazy Japan trade thing that took place last month, and the VIX went from a nasty 65 all the way down to about a 17, or in this case at the close, roughly about a 15. So again, basically just a flash crash, false alarm. I'm not expecting the VIX to really start moonshotting anytime soon. Usually when it sits at these lows, it's indicative of the fact that there is low levels of fear in the market, and that the markets, generally speaking, should be in a bull run. So anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and I'll see y'all later. Peace.